In this video, you will learn about capital allowances. Capital allowances are deductions that a company can claim for the wear and tear of qualifying fixed assets bought and used in its trade or business. Fixed assets are subject to wear and tear over time. This is normally accounted for as depreciation expense in the financial statements. Do you know that depreciation expenses are not tax deductible? Not to worry! For tax purposes, a company will be given capital allowances on due claim for qualifying fixed assets bought and used in its trade or business. Qualifying fixed assets include furniture, office equipment, as well as motor vehicles such as company vans or lorries. However, capital allowances are not allowed on S-plated cars or on items which are part of the premises in which your business is carried on, such as gates or light fittings. Companies may also choose to defer their capital allowance claims. Generally, a company may choose to defer its capital allowance claim when it is in a loss position or when it qualifies for the tax exemption for new startup companies. Companies in a loss position may still claim capital allowances instead of deferring the claim. Any unutilized capital allowances can be carried forward for set-off against the income for subsequent years of assessment or YAs, subject to the shareholding test and business continuity test. There are a few methods for calculating capital allowances. Your company may write off the cost of an asset over 1 year, 3 years, or over the prescribed working life of the asset. Let's go through each method one by one. The first method is 100% write-off in 1 year for specific assets. This method is only applicable for computers and prescribed automation equipment. You may refer to the IRAS website for the prescribed automation equipment list. Some commonly claimed prescribed automation equipment include printers and computer software. The 100% write-off method in 1 year is also available for low-value assets. The cost of each low-value asset must not exceed $5,000, and the total claim for a 1-year write-off of all low-value assets is capped at $30,000 per YA. The second method is to write off all assets that qualify for capital allowances over 3 years. Under the 3-year write-off, capital allowance is allowed in the form of annual allowance or AA, where the annual allowance for each year is 1/3 of the cost of the asset. Assets that do not qualify for the 1-year write-off may be written off over 3 years. The last method is to write off over the prescribed working life of the asset. Under this method, capital allowances are given over an asset's prescribed working life based on the 6th schedule of the Income Tax Act. In the first YA relating to the year in which the fixed asset is purchased, your company will claim the following: an initial allowance or IA on 20% of the cost of the asset and an annual allowance on the remaining 80% of the cost equally over the prescribed working life of the asset. Subsequently, from the second YA onwards, your company will only be claiming annual allowances for the remaining prescribed working life of the asset. This is Big Boss Bobby. His company BB Bakery Private Limited has incurred $1,000 on tables and chairs, $1,200 on a laptop, and $45,000 on a company van in YA 20X3. BB Bakery wants to claim capital allowances on these fixed assets. Which method should be used for each of the fixed assets? Let's first take a look at the tables and chairs. BB Bakery has the option to use any of the 3 methods. Given that these tables and chairs cost less than $5,000 each, BB Bakery decides to claim capital allowances using the 1-year write-off for low-value assets. Next, let's take a look at the laptop. BB Bakery has the option to use any of the methods to claim capital allowances on the laptop. BB Bakery decides to use the option 1-year write-off for prescribed automation equipment, as computers and laptops fall within the prescribed automation equipment list. What about the company van? The cost of the van exceeds $5,000, so BB Bakery cannot claim a 1-year write-off under low-value assets. BB Bakery only has these two options. By using the 3-year write-off method, BB Bakery will claim capital allowances for the van over 3 years. An annual allowance of $15,000 will be claimed in each YA for 3 YAs. BB Bakery also has the option of claiming capital allowances over the prescribed working life of its company van, which is 6 years. In the first YA, BB Bakery will claim an initial allowance of 20% of $45,000, which works out to be $9,000. In addition, BB Bakery will claim an annual allowance of 80% of $45,000 over the prescribed working life of the van, which is 6 years. This works out to be $6,000 each YA. However, this option is often tedious to track and therefore not so commonly used. BB Bakery chooses the option to write off the company van over 3 years. Let's recap. Companies that carry on a trade or business can claim capital allowances on qualifying fixed assets. There are 3 methods to claim capital allowances: a 1-year write-off for prescribed automation equipment, a 1-year write-off for low-value assets which cost no more than $5,000 each, with the total claim of all low-value assets being capped at $30,000 per YA, a 3-year write-off, and a write-off over the prescribed working life of an asset under the 6th schedule. You may visit the IRAS website or contact us for more information.